As the streaming business begins to mature, I think we're starting to see the clear leaders and the clear winners in this industry start to separate themselves. Netflix is obviously a clear winner. I think Disney with Disney Plus, Hulu, and ESPN Plus, eventually ESPN over the top, are going to be clear winners. There's a lot of questions behind that, though. Max is sort of in a middling position, and then a couple of companies that I think are really falling behind and have a lot of questions to answer are NBC Universal, which is owned by Comcast, and Paramount. And Paramount is the company that recently released earnings, and I think this really shows the weakness of this company in the current streaming environment and why this is one of the companies that will probably fail. The general way to think about this industry is through what I call the smiling curve. There are benefits that come to having scale in the streaming business. As you have more subscribers, it gives you more money to acquire content. As you have better content, it allows you to attract more subscribers and charge those subscribers higher prices. And if you're at the bottom of the smiling curve, you're just in a much weaker position. You can't buy the best content. Therefore, you don't attract users, and you have to charge a lower price at the same time. We've seen this play out in social media, where there's really only one company that's extremely profitable in social media. That is Facebook and Meta Platforms. They make all of the money, while companies like Twitter, Reddit, Snap, and many others are losing money in the bottom middle of this smiling curve concept. So if we think about this in streaming media, I think the same thing is going to play out, where Netflix and Disney are going to be able to buy or build the best content. They're going to be able to attract the most users, which they have already done, charge the highest prices, which they've already done, which gives them more profit, to then reinvest in the business and attract more users and charge higher prices. The companies that are falling behind are just going to be left in the dust, and Paramount appears to be one of those companies right now. So I'm going to dig into the numbers and give some comparisons today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. So let's go to some general trends for Paramount specifically, because I think this really lays out the business well. This is a look at their overall revenue and net income, and this is on a trailing 12-month basis since the beginning of 2021. And what you see here is that revenue growth has stalled. The company's actually shrinking a little bit from a revenue perspective, and margins are deteriorating. There are a number of reasons for that. You're starting to have fewer subscribers to the really high margin cable bundle, and that's where a lot of these companies made most of their money in the past. The bigger thing is that we're starting to see the costs that go into direct to consumer, into streaming, start to eat away all of the profitability that Paramount had. That's where you see the company go from $4.5 billion in net income at the end of 2021 to negative $1 billion in the middle of 2023. It's got slightly better in the fourth quarter. But if you look at just the direct-to-consumer business, it's just burning cash year after year. You can see here $6.7 billion in revenue in the last 12 months, lost $1.6 billion. And those losses are starting to get a little bit smaller, but we're not seeing the massive improvements that we've seen at a company like Disney, who's really cutting costs at Disney Plus and attracting a ton of new subscribers at higher prices. So when you have that bigger subscriber base, you're able to make much more impact on the bottom line with any sort of price increase. And this is where I think when you look at their actual earnings presentation, they actually show what a weak position they're in right now in streaming. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This is the earnings presentation. This really shows where the money's coming from or where it's not coming from, where the losses are coming from. This is the direct-to-consumer segment, total operating income before depreciation and amortization, $1.7 billion. You can see the financial weakness there. About a quarter of the revenue is coming from advertising. That's not the case for a lot of the streaming companies. So they're subsidizing some of their revenue. So they're subsidizing some of their numbers with advertising. And I'll show you just how weak some of those numbers are. This is a look at the number of Paramount Plus subscribers and Paramount Plus revenue. If you do the math here, it's only about $5 in revenue per subscriber. So that's going to be advertising plus the monthly subscription fee. So that's really weak compared to a company like Netflix, which is charging more like $15, $20 in most of their subscription plans. But the great thing is Paramount shows what a position they're in right here. This is the revenue per subscriber, and they have all kinds of different tiers. There's the ad tier, there's the standard tiers for Max and Netflix. Haven't added that for Disney Plus yet, but you can see that Paramount Plus at $5.99 is the lowest price along with Peacock. What do those two companies have in common? They're both burning through billions of dollars trying to build a streaming business, and they have a smaller user base than their larger competitors like Netflix, Hulu, Max, Disney Plus. So their financials are just naturally going to be worse. Now, management says that, hey, this is an opportunity because we're planning on a 20% price increase or revenue per user increase in 2024. But what is that going to do to users? If Disney increases their prices by 20%, 50%, they've had some really big increases in the past, and their user numbers keep growing. Why is that? Because they have the kind of library that if you're a family like ours, you just can't cancel Disney Plus. Paramount Plus, on the other hand, would be really easy to cancel along with Peacock because the content is just not as high quality or valuable as some of these bigger services. So as some of these numbers, these subscription numbers get bigger for the bigger players, I think it's going to even push some of the smaller players out faster. On top of that, one of the ways they're trying to combat some of this is a lot of these companies are actually monetizing the existing content they have on other platforms. So if you look at something like Survivor or Paw Patrol, those are going to be valuable pieces of content for Paramount, but they may do better just selling it to Disney Plus, to Netflix, to Hulu, and making more money in the process. But that shows that their streaming strategy is not working. Now, it's possible that Paramount has gotten into such a bad position and is so unvaluable from a stock market perspective that the upside is just on some sort of recovery or sale of the company. Right now, as I'm recording, the market cap is $7.5 billion. The stock is down 51% over the past year. And the reason for that is they just have so much weakness in their strategic position in the content that they have that they're trying to sell compared to a lot of these other stronger competitors. And that's just not going to change anytime soon. So I think the natural conclusion is for them to merge with one of their competitors. I don't know who exactly that's going to be because mergers in the media business are not looked upon very well by regulators right now. So I don't think you could necessarily combine a channel like CBS with NBC or with Fox. So they're in a really poor position strategically, and I think this just makes it an uninvestable company right now. I think the best strategy would just be to get out of the direct-to-consumer business, turn the content that you're making into a money-making endeavor by just simply licensing it to other companies. That may actually turn around your financials relatively quickly, but it doesn't seem like Paramount Plus wants to give up on the streaming dream quite yet. They might be forced into that position eventually. But what do you think about Paramount and the position of the company long term? Leave your comments in the comments section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.